Welcome to the Explainer. Okay, let's talk about getting started in the market. We're going to skip all the noise about predictions and crystal balls. Instead, we're building your very own investor's toolkit. Just 3 simple tools you can use to make your first trades with real discipline.
Let's be honest for a second. The stock market can feel like a total casino, right? You hear all this talk about bulls and bears, these crazy roller coasters. It's a whole language that just sounds chaotic and, frankly, pretty intimidating. It's so easy to feel like you're just throwing your money on the table and hoping for the best.
But what if you just tuned out all that noise? I mean, the stuff you can't control anyway. Instead of trying to guess what the market's going to do next, which is a fool's game, by the way, we're going to focus on something way more powerful. We're talking about the tools that you can control, the things that let you build a real, disciplined strategy you can use again and again. All right, so before we crack open this toolkit, we need to get really clear on the problem we're actually trying to solve. And that problem, well, it has a name. It's called market volatility. Now, this is so important to get. Volatility isn't a bug, it's a feature. It's not a sign that the market's broken or anything, it's just the price of admission. It's the cost of entry for getting those long-term returns that stocks can offer. So the tools we're about to talk about, they're not designed to get rid of the bumps in the road, but to help you navigate them. Okay, let's do this. Tool number 1. This is all about taking control of the most basic, most fundamental part of any trade, the price you actually pay. So think of a market order as the big "Get me in now" button. You're basically telling your broker, speed is all that matters. You'll get those shares, like, instantly. But, and this is a big but, you have zero control over the exact price you pay. It guarantees you get the trade done, but it doesn't guarantee the price. On the flip side, you've got the limit order. This is the only at my price instruction. Here, you're the one in control. Price is everything. You say, I will not pay a penny more than this, and the trade only goes through if the stock hits your price or even better. So what's the catch? Well, if the price never gets down to your level, your order just sits there, and you might miss out on the ride. And this right here, this is the fundamental trade-off, the choice every single investor has to make. It's speed versus price. With a market order, you're guaranteed to get in the game, but the price is a bit of a mystery. With a limit order, you control the price down to the cent, but there's no guarantee your order will ever even get filled. It's a strategic choice you have to make. Okay, so let's keep building. Tool number 2. Let's say you've used a limit order. You got your stock at the price you wanted. Awesome. But now what? How do you protect yourself if the trade starts going south? Enter the stop-loss order. Think of this as your personal, automated risk manager. It's like a preset insurance policy or an eject button for a trade. Its whole job is to take your panicky, emotional human brain out of the decision and just protect your money. Now, it's not foolproof, right? A crazy quick dip in price could trigger it when you don't want it to, but it is a ridiculously powerful tool for making sure you stick to your plan even when you're not glued to the screen. And you can see exactly how it works here. It's all about making the decision before the pressure is on. Before you even bought the stock, you decided what your uh-oh point was. So when the stock hits that price, there's no, should I wait? Or maybe it'll come back. Nope. The plan you made when you were calm and rational just clicks into place. It protects you from yourself and from a much, much bigger loss. All right, so the first 2 tools were kind of microscopic, right? They help you manage a single trade. But for tool number 3, we're going to pull the camera way, way back. Because what if the best way to manage risk had nothing to do with any one stock? What if it was about not having all your eggs in one basket? Just think about this number, 500. That's how many of the biggest U.S. companies are in the S&P 500 index. Now, imagine trying to research every single one of them to find the one needle in that haystack that's going to be the next superstar. It's pretty much impossible. Even the pros struggle with that. And that leads to this quote, which is just brilliant. Don't find the needle, buy the haystack. It just perfectly nails one of the most powerful ideas in investing. Forget the stressful, impossible search for that one magic company. Why not just own a tiny piece of all of them? Why not just buy the whole haystack? And that, my friends, is exactly what an index fund or an ETF lets you do. It's incredible. With a single click, a single transaction, you can buy one share of a fund that owns all 500 of those companies. For a beginner, this is the ultimate tool. You get instant diversification, your risk is automatically spread out across the entire market. It's a game changer. So this is where it all comes together. See, the goal here isn't to master the market.
Nobody can do that. It's not about predicting the future. It's about mastering yourself. It's about having a framework, a system for staying disciplined. And these tools we've been talking about, they are the building blocks of that system.
So let's do a quick toolkit check. You want to control your price? Bam. Limit order. You want to protect your investment from a big drop? You got your stop loss. You want to spread your risks or not betting on just one horse? You got index funds. See? Together they give you a plan, a way to act with intention instead of just reacting on emotion. And really, that's the bottom line. You will never, ever control the market. It's always going to be unpredictable. But you can 100% control your strategy for dealing with it. And in the long run, that control, that discipline, that's what makes you an investor, not a gambler.